watching. Tonight I'm working more on my stock market model in Python. Let me show where I'm at. Well, let me get this out of the way. Stock market. All right, so this is the outline for the model. So I'm starting with can you see this? So I'm starting with a stock universe. You don't want to use all stocks that you have access to. I have access going back to 2011. I'm then using the stock universe. So the stock universe I'm using, I'm only training on common stocks like Apple or Tesla, ADRs, which is foreign stocks listed on the US stock exchange, and real estate investment trusts. I'm then training a returns model. I have a really good returns model. I'll show that in a second. And then I'm implementing that into a portfolio model. So let's go over here to show my returns model. So this is the returns model. I'm really confident in this. It's really good because it's getting better than I want for every metric. So information coefficient. This is the predictive power of the model. I'm shooting for a 0.01 to 0.02. This here I'm obviously getting 0.04. These next four metrics, standard deviation of the information coefficient, I'm shooting information coefficient to information ratio, both on a daily and annual basis. And then the T statistic. These are showing the stability of the model. So information coefficient, predictive power, these next four, stability. So standard deviation of the information coefficient should be 3 to 13 times higher than the information coefficient. Here it's it's about 3 times as high. Daily information coefficient to information ratio, I'm going for 0.04. I'm getting 0.3, so an order of magnitude higher. On an annual basis, I'm going for 0.3. I'm getting basically an order of magnitude higher on that. And T statistic, I want 1.98. I'm getting 3.75. So it looks good for all of these reasons. The returns, basically the when you look at divide the target predictions into decile, it should start with the lowest decile, bottom 10% at the lowest, top 10% at the highest, and then monotonically increase between those. That's exactly what this is doing. And then I do a walk forward analysis to see how does this model perform over time. And it's performing, it's getting above the information coefficient that I'm trying to get every year. And it's also doing that on the information coefficient to information ratio on an annual basis. So for those reasons, I'm confident my returns model is really good. And now I need to do the portfolio model. So I've been looking into the portfolio model. Here I got something which isn't good, but it's something. What was good was the drawdown. The worst drawdown was 3%. So it's definitely something I could tolerate over time. But then here's the return over the test period. So that's not nearly good enough. I tried a simple model. This wasn't performing well either. So now these are my to-dos for today. This should improve the walk forward analysis a lot. And then once I do that improvement, I'm going to reassess, then write in some portfolio optimizations, incorporate hierarchical risk parity, become educated on modern portfolio strategies. Let's see if there's any comments. Okay. So let's go here. what was it again? Hierarchical risk parity. um, oh, so I have, did I save this? So Portfolio Explorer. Test get portfolio. I think that's the last thing I ran. But then I need to save the portfolio. What? Did none of this save? Oh no, I haven't gotten to implementing this. Walk forward portfolio, save. dates dot to start, dates, where's dates? Dates is read CSV. Equal weight I already have. Risk parity. Ignore expected returns entirely. Just find the portfolio with the lowest possible variance. You'd use your model to select which stocks to include, then let minimum variance decide the weights. mean variance, Markovits. Bloch-Literman, a sophisticated extension of mean variance that blends market equilibrium returns with your own views. The idea is that pure market cap weighting represents the market's consensus expected returns. Ratio of weighted average volatility to portfolio volatility. I don't know if that's going to help. Very good. Portfolio object has no attribute model. 11, 12, 13, 14. Hey, Sir Night Night. How are you? How have your models been doing? Also, it looks like that. Uh, Look, it's suggesting I use signal tilted HRP, hierarchical. What you suggested yesterday. Hierarchical. What? I forgot. Risk parity? Yeah. Hierarchical risk parity. Signal tilted, then it's using my model. So I need to implement that. But before that, I want to get a better walk forward. So I'm only using a static number of years. I want to use the maximum number of years available for training. figure that out next. But right now I'm going to run Model Explorer. Alright, so let's see if it works. Oh, it's gonna compute everything first though, so I'm not gonna go worry about that. I might have to troubleshoot this though. Okay, so that's running. Let's get out of here. Oh. Hey, Javi. Um, Epiphanies. Epiphanies, no, but I figured some stuff out, both for work. I'm doing literally the same thing for work, just working on a model. Um, and then, Sir Night Night gave me an epiphany. Hey, AI fusion, does that mean you are interested in nuclear fusion? Yeah, let me give a quick overview. Um, but so I don't lose my train of thought, I'm going to look up OS make DIRs overwrite. Yeah, let me go over it real quick. So this is my project. I have two goals. First goal, beat the S&P 500 by a significant margin and make money in all regimes. So I want to be doing, at least 3 times better than the S&P. But if the S&P is going down, I want to still be making money. Not outperforming the S&P but losing money. I want to be making money no matter what. Now I'm writing all of this in Python code. So I have a second goal, which is to create a usable Python tool that anyone can use to create advanced models for themselves. I've already done that. Everything that I'm using currently is available in this repository, which is linked in the description. So you can, I have a really good model going, and I've created the universe for the model. So this is the outline. Create a universe, feed it into a model, and then use your model to predict returns. So I have a really good model right now. I've done all sorts of testing to make sure the universe is good. I've done all sorts of testing to make sure the model is good. And the model works in under 100 lines of code. I've created my model. So you can do the same thing because all the code's available here. I don't have the model on here, but all the code I'm using to make the model is all on here. So you can try this out for yourself. If you find it interesting, please star it, watch it, and follow me on GitHub because that stuff helps me out a lot. So this basically I have all stocks going back to 2011. Oh, another important thing here is it needs to be free. That's the requirement I've placed on it. Everything it uses has to be free. So, I have data going back to 2011. I have a free data source for that. There's a tutorial in the repository on how to install it. I have sector information, and all of that I've gotten from scraping the SEC Edgar database. What else do I have? Oh, like rate information, treasury rates. I've also gotten that from scraping something. I don't remember if that was SEC Edgar or not. But basically all the data sources are free. Now I have data going back to 2011. You don't want to include all stocks, everything in that data set into your model because some things make the model perform worse. For example, NASDAQ has test tickers, which they use, I guess, for testing their framework. And those never change in price, and you can't buy those. So you don't want to include those in your universe. I'm training this model on common stocks, ADRs. Common stocks are things like Apple, you see in the market, an American company. ADRs are foreign companies that are listed on the U.S. stock exchange. And then I'm also using REITs, real estate investment trusts. All those have price dynamics which are similar to each other. You want to exclude things like penny stocks because those are going to throw your model off. You want to exclude things like low volume stocks. So I'm feeding all that into the returns model. I've created a class for defining features, and I have all of these price features here defined, and I've added quite a few more since I made this list. And so the next step is to make a portfolio model. So that's what I'm working on right now is the portfolio model. And I just wrote some logic to do the walk forward again on the returns model. So the models should be better now because it's using more training data. So this is the model I've got, which is performing really well. And so how do I know it's performing well? A few things. First thing, I'm looking at these metrics. The information coefficient is basically giving the predictive power of the model. Oh, this isn't it. Here it is. So this predictive power of the model, I'm looking for 0.01 to 0.02. We're getting 0.047, so way above the threshold I'm looking for a good model. These next four features, standard deviation of the information coefficient to information ratio on a daily basis, same thing on an annual basis, and the t-statistic, these are all showing the stability of the model over time. So you don't want a model that performs well but is unstable. You also don't want a really stable model that doesn't have any predictive power. You want to balance those. So I'm getting way above my threshold for predictive power. Standard deviation of the information coefficient should be 3 to 13 times as high as the information coefficient. This is about 3 times as high. Information coefficient to information ratio should be 0.04, I think it is, on a daily basis. It's 0.3, so larger by an order of magnitude. On an annual basis, it should be 0.3. It's 2.27, so again, larger by an order of magnitude, and the t statistic should be 1.98. I'm getting well above that at 3.7. So it's performing really well on these metrics. If I plot this is called a decile analysis. So your predictions, the bottom 10% of your predictions should be the worst performing. The top 10% of the prediction should be the best performing, and this should be monotonically increasing. So each decile is outperforming the previous decile. That's one hallmark of a good model. So I have that here. Also, if you look at the long-short spread over time, it's performing really well. And so the next thing I looked at was a walk-forward analysis. So this is one data split. It's training on, let's see, it's in here. So dates, quick look. So it's training on 2011 to 2020. It's validating on 2020 to like mid 2020 to first quarter 23, and it's testing from the first quarter of 23 to the beginning of 2026. So these are the results with that data split. It's only one data split, so instead I did a walk forward. Here I'm grouping it into, let's see, I think I'm using 8 training years, 2 validation years. No, this must be one. I think it's 7 training years, 2 validation years. So the first, so it's 9-year groups. The first 7 years of the group are used for training data. The 8th year is used for validation data, and the final year is used for testing data. So these are the test years, and you see, so it works well on one data split, but does it work well on any data split? So this is basically showing that, and you see the information coefficient. Remember, I want above 0.02. I'm getting above that for every single year. Annualized information coefficient to information ratio should be above 0.3. I'm getting that for every year. So for all of these reasons, I'm really confident on the model, and so now I'm working on a portfolio model. So this was the first attempt at a portfolio model. I'm basically optimizing using a Bayesian optimization to get, basically I'm giving large market level features into the model. These are the features. So volatility index z-score, how many standard deviations is the volatility index away from the average? The rate spread, so these are all just treasury rate features. So I'm feeding those into the model and trying to optimize the model. And I'm penalizing drawdowns in the optimization objective function. So you see here, this looks pretty good here, but there's a problem. So it's only returning about 15% over 4 years, and so that's pretty bad. 15% over 4 years, you could just buy and hold the S&P 500. So that negates my first goal, which is to beat the S&P 500 by a significant margin, at least 3x the S&P. The drawdown, however, looks really good. The worst drawdown is 3%. So, even though these returns aren't the best, I'm never getting hit really hard. At worst, I'm having a drawdown of 3%. The rolling Sharpe ratio doesn't look good. It should really never drop below 0. So this is the first optimization I did for the portfolio. The second strategy I was looking at for the portfolio is a simple backtest strategy. Basically, no optimization is going on here. We're just backtesting. And you see this is performing really poorly. I was also looking at a long-only strategy because I want to implement something into my Roth IRA. If you have a Roth IRA, you can't short sell. So you can only go long. So I'm trying a long only model, and you see that that's giving negative returns. So now today I'm looking more into this portfolio model and seeing, how do I make this work really well? These are the to-dos. I hope that was a decent overview. I'm getting my ass kicked right now. Well, that's not good. Sorry to hear that. Hopefully your model gets going better. Alright, so the walk forward, where are we at? So this is the first split. 4 years of training data, 2011 to 2015. Now the next fold should have 5 years of training data, 2011 to 2016. It does. Next fold, 2011 to 2017, good. Next fold, 2011 to 2018, good. Okay, so this is working well. I need this to finish. And then for the portfolio optimization, basically there's a trade-off here. So the fewer number of, however many years I'm looking back, I'm going to have fewer. If I look back more years in the training data, I get a better model, right? But the price I have to pay for that is I have fewer test years here. Conversely, on the portfolio strategy, I only have these test years to use, 2020 through 2025, and so these are the only years I'm getting results for the model. So when I optimize the portfolio, I'm limited because I have to use those years. So I'm trying to use more years, which should improve the model performance, but that's what's running right now. We'll see. So Sir Night Night suggested a good portfolio strategy to use, which was hierarchical, what is it called again? I forgot. Hierarchical something. So I need to incorporate that into my model. I put it in the notes here. Hierarchical risk parity. So, hierarchical risk parity isn't going to take into account the output of my model, the full output of my model. It's only going to take into account the ranks of the model. So I'm going to change this and have it do, what was this called? Signal tilted hierarchical risk parity. How can I implement signal tilted hierarchical risk parity into my model, into my portfolio code? Don't write any new code yet. Let's just discuss the high level structure. Now let's highlight these so I know what I've done and what I still have to do. And I've done this. Okay. Where are we at? It's 12:12 here in Colorado. So how many minutes am I at? 57 minutes. I'm pretty tired. I went hiking today in Rocky Mountain National Park, so this isn't going to be a really long stream, but I have to do at least an hour stream. So let's look into how I'm going to change the code. Stop that. Copy that, and I'm going to give it the code. It already has the code, but it has an old version. So I'm going to need to update that code version. And let's update some GitHub changes. So first, let's just add advanced models, updated walk forward to use a variable number of training years. What's it on now? Okay, so it's testing on 2020 right now. Added classes for rule-based portfolios. Updated portfolio class logic to optimize RAM and save. Alright, let's see what it says. So I need to get covariance. HRP weighting function. Signal tilt function, yeah. Weighting strategy abstraction. Right now, rules-based backtest doesn't have a concept of how to weight positions. It would just equal weight. You need a way to plug in different weighting schemes. Okay. That'll be easy, just add into the portfolio. Okay, so this is what I'm going to be working on tomorrow morning on my stream. But like I said, I'm tired. It's been a long day. So, thanks for watching. That's it for tonight. Have a good rest of your day. Adios.